So a lot of doctors talk about leaving medicine, and some people talk about going to do something else, something more exciting, maybe financial rewarding or even a bit more flexible. So why would an investment banker working at a highly reputable global bank leave her job as an investment banker to become a doctor in the NHS? In this episode of Moneywise Doctor podcast, I had the opportunity to chat with Dr. Vanessa Awong Eya'a, who is an ex-investment banker and currently a doctor in the NHS, and also the founder of a health tech company that is looking to address a very important problem in the femtech space. So she shares her interest and how she decided to become an investment banker and how she decided to pivot from investment banking to becoming a doctor, as well as whether she had any regrets and her exciting new project, what she's talking on now. So if you're interested in finding out, is there any more beyond medicine, and is there more I can do as a doctor? If you're thinking about the best way to even take charge of your financial future, this episode is for you. Enjoy. All right. Welcome back to MoneyWiseDoctor.com platform today. Today we are on an interesting episode where we're going to be interviewing someone really fascinating. As you know, every now and then it's me just droning on and on about how to make better financial decisions for doctors and healthcare professionals. But every now and then I find someone who's doing something really interesting, something I think I should bring to you. And today I've got an interesting lady here today, Dr. Vanessa Awong Eya'a. So Dr. Vanessa has gone from being an investment banker to becoming a doctor. And she didn't just stop at becoming a doctor. She's got some interesting project on the way, which we're going to talk about at some point during the podcast. So if you're in for the ride, join me as we welcome Dr. Vanessa Awong Eya'a.
Hello, thanks for having me.
You're welcome, Dr. Vanessa. Right, so a bit about her background. So before she decided to become a doctor, I mean, a lot of people go from being doctors to being consultants in management consultancy or investment bankers. If you followed a bit of my own journey, I was a doctor, went off for 4 years, did quite a few things, started businesses, worked with NGOs, came back to work as a doctor, and now sort of I'm in a portfolio role now. I think the last time I was in a GP surgery was about 4 weeks ago. So every now and then I've got to keep my license. I do 40 sessions a year minimum. Right, so but Dr. Vanessa has actually worked at the tippy top. So she's worked as a corporate analyst at BNP Paribas Corporate and Institutional Banking. She's worked as an associate director at UBS, so quite a heavy hitter. If you know anything about banking, these are sort of like the big investment banks. She's worked as a leverage financial analyst at Sumitomo Mitsui Banking Corporation, and of course she's been an entrepreneur at Antler. But things changed from I think 2019. She became a medical doctor, so she definitely went to medical school in between her banking career. And currently she's the co-founder and CEO of Eve. And there's also in her personal life something quite big, which is massive respect, being able to juggle being a mother of a newborn and doing all of this. So welcome back, Dr. Vanessa. So can you tell me what I've missed? I'm sure I've missed a lot there in your profile.
I don't think you missed anything, to be honest. But I think it's probably because I didn't put it on LinkedIn. I had the first venture in 2008.
Right.
So in between my banking. So definitely like entrepreneurship and setting up a business. It's always been at the back of my mind.
Yes.
And I've tried a bunch of times, even in between the 2008 and this one.
What was the first venture? What was it about?
So it was an online editing space where you could read your book on a website, and it was just before the Kindle. So
wow.
Initially when I pitched the idea, people was thinking, why would I read on the screen? I like my books. I like the physical paper.
Oh. Let's just say you were early. Yeah,
so I was early, yes.
2008, I was still in med school, and I had the idea that I'd launch my first business, which was just a blog at first, before I ventured into other things like web SMS, software, and clothing. So you were thinking quite far ahead, far back then, because Facebook was only started 2005.
Yeah.
Yes, I'm not sure
Yeah, yeah.
YouTube existed in 2008.
YouTube existed at the
How did it?
time.
All right.
The iPhone had just come out.
Yes. Okay.
Uh, so it was still like big on Blackberries,
Yeah.
and the iPhone had just come out, and the Kindle hadn't come out at that time when I launched it.
Amazing.
And so
Amazing.
yes, I think I was ahead, but in a sense, when you're a pioneer, well, you're first. That's great, but at the same
Yes.
time, you have to educate, and
Yes.
educating people requires a lot of investment.
Requires a lot of investment of time and sometimes money. I mean, we do financial education, so even when you think about things that are old concepts, like of course you should know that if you invest this way, this is the type of result. You know about the risk and all of that. You think it's old information you've known for 20 years, but it's new to the person when they hear it. And that
Yes.
leads me to a segue: investment banking. You've gone from being an investment banker to being a doctor. Why?
I get these questions all the time, especially from doctors. Not so funny enough, not so much from bankers, but from doctors. Every
Yeah.
time I get the questions. Well, I think I wanted to have more of an impact. I know it sounds very cliche, very easy
Does
nowadays.
it?
But well, every time I say it, I feel
I
like
believe
it's
you.
going to-
I believe you
Really?
because obviously I've spoken to you a few times and yeah, we've had a few chats. So don't worry, I
Yes.
believe you, and I'm sure my 2,000 subscribers, they believe me most times, so they'll believe you as well.
Yeah, trust me, I'm a doctor. So yeah.
Of course,
Yeah. Which I couldn't say if I was a banker.
Oh no,
But yeah, no, really, I often I said this anecdote at the time when I was working in banking, especially UBS. My boss was saying to me, but you know the impact. I didn't say that I wanted to do medicine, but I was just I guess I was questioning the impact I was having.
yeah,
And he said, but you're having a lot of impact because you're making sure that the retiring teacher,
yeah,
I don't know, in central Canada, in the middle of nowhere, will get his pension in 30 years' time.
yes,
And for me, I think it just sounded like too too far ahead
too far away.
to see the impact.
Yeah,
And so I started thinking, how can I have a more direct impact on people? And my mom is a pharmacist and my dad is a vet. So the medical world was at home.
Oh, I see.
And initially they wanted me to be a doctor, which I didn't do for many reasons that we don't have to go into. But then I started thinking, oh, well, maybe I could become a doctor. Who knows? And also I like I think I probably watched too many Grey's Anatomy at that time. And I thought, wow, the impact is great. Let me find out for myself. And so I started talking to doctors who were like friends who were doctors, other doctors. I did an internship in a hospital to follow doctors so I can project myself as in terms of their day-to-day operation, because you have this fancy idea of sometimes of a job, but sometimes when you're in trenches and doing the day-to-day, you might think otherwise.
Yes.
So I really wanted to experience that. So this is what I've done for like a year, and I spent also some time with learning, children with learning difficulties, because also I wanted to spend time with what we would call probably more difficult patients.
Yes.
So I spent that time, and then at the end I thought, yeah, I quite like it. So let's get on and let's try then. And so I signed up for all the exams I could to get into medical school here in the UK. While I was still working, so I was literally like waking up at 5, do my science, because I hadn't done science in a very long time. Refresh my chemistry, my biology, my physics.
Wow.
And then I took the exams, applied, got an interview, and then I did it in two rounds. So I applied first year, didn't get in, then applied the second year, and then I got in.
Wow. This is such an inspiring story. And the thing is, with an average doctor, let's say someone like me, I got into med school as a teenager, and most of us got into med school as a teenager. Most of the time, most people hadn't had reflection to think about. I know I'd already seen doctors. I had an uncle who was a doctor. I'd seen some doctors, and I'd also read the book called Rich Dad Poor Dad, and I started reading books like The Intelligent Investor, which I started investing in the stock market at that age, and I thought I was late, actually at 18, 19, only to find out most people weren't. But I was going into med school, and I was thinking, is this really the best career option for me? And I knew even now that I still like working as a doctor. I enjoy working as a GP if I don't have to do it. So it's fun for me. If I can come and go. But in your case, it's a very different matter. You've taken a very considered approach. You've not said, oh, like most people, they see Grey's Anatomy, oh, I want to make my daddy proud. And then they've gone to become doctors. But in your case, if you actually worked in what I'll consider is a real world of yours, so investment banking is a world of its own, but you get to see all sorts of clients, and you worked at BNP Paribas and all those. In case some of my listeners don't know, UBS, I think that's one of the biggest banks in the world, is it?
Yes, it's one of the oldest. Yeah, it's Union des Banques Suisses. So one of the oldest Swiss banks, and they recently bought Credit Suisse. Yes.
Yeah, they grabbed Credit Suisse. Eventually, that was bound to happen. Could you say the UBS again? Do you mind saying the full name again?
Oh, Union des Banques Suisses.
Excellent, sir. Now, if you don't know, that's the part I missed at the beginning. Vanessa, this beautiful accent you hear, she is French. Is that correct?
Yes.
You're French? Yeah. Yeah, so don't confuse her with mine. She's French. So I thought I might practice a bit of French so that we'll do this interview in French, but I couldn't go beyond them. Tu parles français, yo. Je m'appelle DBC Egrim. Comment ça va?
Oui, ça va bien, merci. Et toi?
Oh, no, that's about the level of my friend. Maybe we should just stick to English. Is that all right?
Fair enough.
Yeah, so you've been on this amazing journey. You've gone from being an investment banker. I mean, you thought about being a doctor, and you had a medical background. You thought about it. So this was not anything about doing what your parents wanted, obviously, because there's always a part of us that want to make our parents proud. But this is obviously different because you've actually gone, experienced a different career. And I didn't know that bit, that you actually went to work with children with learning disability, which is quite demanding. Yeah, having worked in CAMS as part of my earliest jobs in the UK. So you did all that job, and then you decided, some people say this career is not for me, I'm leaving. And a few doctors are leaving, but I think that's the pathway I'm going to go. Is that the case? Is that what you decided to do?
Yes, exactly. No, I wasn't put off at all. No, I mean, even the contrary, because then I went on to do all the exams needed to get into med school. So no, on the contrary, I guess it fueled me thinking, no, I like the variety. Yeah. I like the flexibility of being a doctor, because once you're one, literally, as you said, you can be a portfolio GP, but you can be a journalist if you want to in the medical space. You can work for pharma if you want to. You can work in research. Like the world is endless, and I think this is what I like probably the most about being a doctor.
Wow, you can be a podcaster and a blogger and tell people about financial.
Exactly.
Right. Look, for those of you listening and you're wondering, is medicine for me? And there's been a lot of talk about leaving medicine and all that. And it's always good. I mean, when people want to leave medicine, I say test it first. Maybe take 3 months off if you can afford it. And in my case, I couldn't do it in the past because of my visa situation. But part of why I was able to resign my job, and I've got these flexibilities because I've got my permanent visa to stay in the UK. So for immigrant doctors, some of who listen to my podcast, that might not be the case at the beginning. But if you get the opportunity before leaving, test it first. Maybe don't just jump, because I'm seeing someone who's come from a world from where we think, lots of money. Some doctors think we're not adequately paid, and there's an argument for that it could be paid better, but there's a lot more other than pay, like fulfillment, satisfaction, and it may not be all black and white. I'm either all in medicine or out of medicine. For some people, a portfolio role where you could do one thing and then do another thing also matters. Right. So very inspiring, Vanessa, being able to go back to study physics and biology and chemistry after being in the world of crunching numbers and all that. Now, let's get into that world of investment banking. Obviously, not too deep. What are the top things you think you might have learned from investment banking that you think might have helped you in your career as a doctor? I know one clear one is obvious. You've mentioned it even without realizing it.
Yeah.
Getting up by 5 a.m., all that long hours, hard work, investment bankers.
Yeah, definitely the hardworking aspect. Yeah, probably hardworking. But I felt like I was hardworking even before I started my career as a banker anyway.
Yeah.
Because in France, I went through like a specific program where literally after the equivalent of A-level, you do like 2 years of like literally just working. And you're
working. Like what sort of work?
It's studying. When I say working, it's more like studying. Like you just do 2 years of just studying, and there's no you barely see the lights.
Yeah.
And then you get into those business schools or engineering schools, and then after that, life is easier. So in that sense, those years prepared me for the banking world, almost to the point where I was thinking, I don't think I work hard enough. I was so used to work and be like dedicated, like concentrating on one essay for 4 hours, and then suddenly it's a bit more
easier.
Yeah, exactly. It's easier. So yeah, definitely the hardworking aspect is one. I would say the structure. I quite like the structure in banking. Everything is almost in like boxes. But at least in that sense, it's very structured, and I like that. I personally enjoy when it's clear cut. This is what you do. This is the goals.
So you have no problems with guidelines then? Guidelines.
No,
nice
I have no problem with guidelines. I know that sometimes I'm a bit like, but most of the time, no, I don't have any problems.
Right.
Yeah.
So working hard, structure. Yeah. Is that the two, or is there anything else you could say that your banking career? Because it's quite a move from banking to,
Yes.
I was going to say banking to blood banks, but it's not hematology.
Yeah, exactly.
You're doing, is it?
That's a good one. I think learning about how money works was good in a sense. Well, good and bad, depending. In a sense that because I understand, how to analyze from a financial point of view an organization.
Yeah.
When I was on the ward and the manager would come and then basically would go into an argument with the doctors, we need beds. No, but no, I need to look after the patient. No, we need beds. I can understand like both point of view, because from the manager point of view, it's about costs. And at the end of the day, they have to make sure that at least we're supposed to break even, but which I think most of the trusts don't. And then on the other side, you have the doctor saying, "Wait, but my duty is to the patient, not to the bottom line of the organization." And so I understand both, and so it's always hard, kind of like in the middle.
All right.
Trying to defend one towards the other. Trying to explain both point of views. Because any organization, if you really want them to be sustainable, they have to break even at least. Yeah. And unfortunately, that's just a fact.
I mean, having that sort of balance and having that sort of seeing it from both ends, I think it's quite a rare skill. It's something that I'm sure the NHS could use more of, having people who are skilled on both sides. That will lead me to a segue. Basically, you've interacted with lots of doctors, and you've come from banking, you've interacted with a lot of bankers. So being a doctor, knowing that I've got maybe 2,000 doctors, healthcare professionals watching this, and maybe one banker or two, I'm going to ask you from the doctor side, what are the commonest financial mistakes that you've noticed doctors make when it comes to money. Obviously, doctors and healthcare professionals, we don't get a lot of training on money and all that. We just start doing jobs and we suddenly realize, I've got to pay a mortgage. Oh yeah, childcare costs that much. Oh, I didn't claim my taxes back. Oh, do you mean I've got to invest now? NHS pension is not enough. So what are the commonest mistakes you've observed? I mean, from that your advantage of being a banker has come to medicine.
Definitely the pension aspect. I don't think we realize the low level of pensions we're going to get. Just mathematically speaking, it just doesn't add up at all.
Okay.
And it's just not just the NHS, it's generally speaking, it just doesn't add up from a math point of view. So meaning that when I personally know that I will not get anything interesting as a pension. So I'm working. So probably that's why also the entrepreneurial aspect is coming, because I'm like, Vanessa, in 20, if you want to retire in 20 years, you're not going to get anything, because it's just mathematically speaking, there won't be much for you to spend on. So you're going to have to either get into a job where you can work pretty much up until you die. And that's why I thought medicine is great, because you can work up until you're 100 years old if you want to.
Yeah.
So I thought, let's have a job that I can keep until
I want to. Until you want to.
Until I want to.
That's quite profound.
Yes.
Yeah, I know you've got other points, but I just want to bring you back to that pension thing. When you say pension, do you mean every other pension or just NHS pension? I know you're an analyst. You've worked as an analyst. You think the NHS pension wouldn't be enough for most people when they retire?
Yes. Yes, I think it won't be enough for most people to retire. I think the people retiring now are probably the last few who would get a good pension. So meaning that definitely my generation, when we're going to come in 20, 30 years time, there won't be much left.
Right.
There won't just be much left.
Right. And why is that? Will the money go away, or there's not going to be enough, or is it inflation? I know it's index-linked NHS pension. I mean, I'm not in the NHS pension now because I'm not a salaried doctor, but why is that? Why do you say that?
It's because the pot that we put on the side, it has to grow with a certain growth rate to be able to pay for everyone's pension.
Okay.
And unfortunately, the growth rate at which it increases is lower than what is needed to meet the demand.
Right.
And it's the case for most pensions. I don't think there's any pension I've seen.
Yeah.
Well, it's been quite some time, but that was the talk, saying pension was actually a debt when you were analyzing a company, because you're thinking, well, they have this number of employees, where you can do calculation of how many you think going to get into their pension age, and we see the pot and it just doesn't match. So it means that either the company will going to have to raise more funds,
which is more debt,
exactly,
okay. Or selling of equity,
or they are going to have to do something, because they cannot, the two don't match, and it's just the case for most pension. So they're probably going to try to either indeed increase the age of retirement, because then you work longer, and so you're gonna contribute for longer to your pension. That's one way. But the other way is also to say you're just gonna get less.
Oh wow! I mean, that's quite chilling. I'll say a bit not scary, but I think sometimes when you're hit by reality, and it's not just coming from a random person off the street. This is giving your background as an ex-investment banker. This is not numbers you're throwing around, and I'm sure if we got into spreadsheets and sat down and look at it step by step, it might take us a few hours. Yeah, but I think I agree with the point about making alternative pension plans. The NHS pension, consider it as maybe one source of income, or whatever pension you've got. For some of us who've got SIPP, self-investment pension plan. But I think it's good to have alternative options. You can have your lifetime ISA, you can have your NHS pension, you can have an investment property, you can invest in the stock market in different ways. I think it's having that multiple streams rather than depending on one. Because what you said about the age increasing, it's obvious, because before, pension age used to be less, maybe 60, then 65. And then for people in my generation, which I'd say you are, is 68. So who knows, maybe to get to 72, then 75. And it's just like being in a pot of boiling water as a frog. You just keep it boiling, and before you know it, it's 100 years.
Exactly. You're probably going to see doctors 100 years old just because of that. It's just it just doesn't add up at all. And that's, I know it's one thing that is difficult to necessarily like envision, because we're talking 20, 30 years down the line.
Yes.
But unfortunately,
it's true.
The math doesn't add up. So we have to, I think I would definitely advise all your listeners to look at their pension and start thinking deeply how they can have something on the side that would bring complementary income.
Fantastic. Thank you. That in itself, if you missed any part of this podcast, I think you should lean in, take a note for this one in particular. Pension. One thing about investment in the future, most people are not thinking out into the future, they're thinking about now. And when we do Moneywise Doctor.com, focus on helping doctors avoid financial mistakes. But it's not only about now. I mean, there's a lot of things they can do right now, but it's most times projecting into the future. So that's one big mistake, not looking into your pension, assuming that your pension covers everything. I think you should be thinking about your pension, at least even finding out what your pension could be in the future. Are there any other costly mistakes you've noticed doctors making, or,
probably tax. I've noticed that we tend to just accept. I personally have an accountant, and so he's doing my return.
Okay, so do I.
He's doing my return, and then I do manage to get some taxes back. So I would also advise definitely doctors to get an accountant and get your returns done, because I'm pretty sure there are some stuff that are missed. And it's just time consuming. I mean, it depends. Some people really like taxes. I'm not that much of a fan, so I just hire someone to do it on my behalf. But I know I have a friend of mine. She's really deep into taxes, and she literally look at every line in her payslip, and she can tell, no, this is not the right code, and she would go and literally harass people so they can change it so that it's correct or you. But I don't have that to do.
This is such an important point. I mean, basically, you are an ex-investment banker, so you know a bit about numbers, but you don't do your own taxes. I like to quote Benjamin Franklin, who says, one of the founding fathers of US, that nothing is certain in life except debt and taxes. That's debt, not doing, but debt. So like you, I've done my taxes self-assessment. Rather, I did for my wife, and it was a lot of work. And I thought, from day one, even before I started working as a doctor, so I was getting my GMC license, I registered a limited company. I've been working with an accountant from day one. And a lot of people, why would you pay that much? Because I've got other businesses now. But as at then, I was to work as a doctor, because as at then, I could work outside IRO 35, which is a different discussion. And people say, why are you spending that much on an accountant? If you think about it, an accountant costs you £200 for the whole year, sometimes less, sometimes more. And then they save you a massive amount. And even if they don't, sometimes just making sure that you're not making a mistake. You don't want HMRC knocking on your door. You don't want the taxman or taxwoman knocking on your door to say, oh, look. Because it happened to a colleague of mine, and after some years, they say you were owing £20,000, 23,000 actually, because you didn't have your tax. But that's really quite key. So I'm taking a note of this. One is pension, look into your pension. Two is taxes. I love the direction you've come from. You've not started out from investment, which I'm sure that you probably get into at some point, but you focused on the things that could be quite negative and costly, like not making sure your pension is sorted, and either overpaying or underpaying taxes. Is there anything else? Because these are quite golden nuggets.
Well, I mean, generally speaking, about the usual, saving money, but I know it's easier said than done.
Okay.
So even me, I'm still working on how much I can save,
Okay.
so I can invest a lot more. I still have my eyes on my pension. making sure like I keep my license just in case I need to work when I'm 100 years old.
Okay. As you can see, I'm keeping my license, and I did my appraisal last week and had to prove that I've worked up to 40 sessions in a year. So that's the minimum you can do. You have to assure your appraiser. So if you can do 40 sessions, so if you come to GP, if you're a GP and you can do half day 40 times a year, that's 20 days, then and do other things you need to do, you'll be able to keep your license most of the time. I'm not GMC. I think it might be a bit more tricky for hospital. I don't know. It's something you have to look into at some point. But thank you so much. So pension, taxes, and also obviously talking about keeping your license. Don't just jump out and say, I'm going into one field. People say health tech or medical, and I'm thinking health tech is brilliant, but you're a founder, you're doing some work now in health tech, but you're still keeping your license, you're working as a doctor. It doesn't stop you, and we're going to get to that in a minute. How about investment? How do you think doctors should think about investing? I think I've been investing for almost 20 years now as a doctor, but I didn't know anything about indexes when I started investing. I was of the class of value investment and fundamental analysis. In fact, I'm heading off in about a week to Nebraska, Omaha, for Warren Buffett's Berkshire Hathaway shareholders meeting. So I'm in that sort of like investment, but along the line, I've got a kid now. I've got a toddler. I've got a kid just like you, and then I've got a family. I'm now thinking about investment from a different point of view. Obviously, I still take position in companies and all that, but I think most doctors might be better off with index fund or minimal risk without having to do analysis. But what do you think? You are the expert. You're the one who's come from investment banking.
Yes, no, definitely. If because it is actually a job to analyze companies. Yeah, but I used to do it.
It's a big job.
It is a big job, and it takes a lot of time. And Warren Buffett probably was going to tell you, he spends these days like
all day
reading annual reports, looking at economic trends. So it is a proper job. So I would definitely advise, if you don't have that time, just go for an index. Easy, simple, passive. So it's a passive kind of. So we call it like passive in passive investment term.
It's passive, passive versus active,
Yeah, because you don't have to pay an extra if you go for active. Active is when the portfolio managers bet on certain companies.
Alpha.
While the index is just a weighted average of different companies, and you don't care what's happening. You just hope for the best, and historically speaking, the indexes tend to do actually better than human portfolio managers.
Maybe the thumbnail should be "Ex-investment analyst reveals the truth," because I've got a blog post on MoneyWiseDoctor.com that says 99.99% of full-time investment analysts and professional money managers underperform. They do worse than the S&P 500, which is basically an index that looks at the top 500 companies in the US. So that means that somebody, let's say my grandma, of blessed memory, if she had a bit of money and she just put it on the index fund and went about doing her regular duties and doing whatever she liked to do, without knowing how to analyze a company, without flying off to shareholders meetings in Omaha, or without even reading one book, she probably will outperform 99% of suit and tie, power gowns and power suits, professional money managers. It's going to outperform them. That's what the data is saying, and you agree with that?
I agree with that. It's true. It's very true. Unfortunately, on how you want to see it, like that would be great for your grandma.
And it's fortunate for most doctors who don't have the time to do the sort of analysis I do and you used to do.
Exactly. So you just put your money into the index, and then based on your risk, we call it risk appetite, as in because the thing is with S&P, sometimes you do have crashes, and you have to stay level-headed, thinking, okay, it's just a crash, but historically speaking, it tends to go up. So I can't remember, is it like 8 to 10% a year if you go historically speaking? Despite the crashes. So during the crash, you just wait. So in that sense, going for the S&P or one of these indexes is great. But if you don't like too much the idea of it can go up and then crash and then go up and crash, then you can mix up the combination between stock market and debt market, because debt market
bonds.
tends to be bonds exactly tend to be less risky. So me, for example, I just started investing for my kids, and I put 100% into stock market because they have a very long time
investment
horizon.
Profile. Yeah,
exactly. And I have no idea about risk, but I have the risk appetite for them.
Yeah, okay.
While me, I think I'm 60 stock, 40 debt, something like that, or 70 stock, 30 debt. So I have more stocks because I have a longer time horizon.
Yeah.
But I do want to keep a little bit of my options in a less risky vehicles. So I would say, don't have time, indexes, and based on when you're going to retire or when do you want to get that money, then you adjust the risk profile. And you can do it from, most of the products. You can literally choose yourself your allocation. So that's one thing. Then the other thing is, if you have more time and you're really passionate about the idea of analyzing a company, then yes, maybe you can put aside on an index, but then the other side is like, okay, I'm going to bet on that company because I believe in it. And as doctor, you can look into biotech companies. You can probably understand most what's happening compared to others. So that could be a way. But if you don't have time, indexes are the best.
Wow, I suspect, we could end up in a masterclass on asset allocation and how to invest. But before I delve in, I want to just mention, if you're watching this, I'm sure Vanessa agrees that none of this is professional financial advice. We're both doctors right now at the moment, and even if we were financial advisors on YouTube, do you really want to invest based on that? You definitely want to talk to a professional financial advisor if you need one, because most of us end up not needing one, except when you want to do specific things like get a trust and all that. Yeah, so do you agree that's not professional financial advice?
That is not professional advice. This is just a conversation between two doctors.
Now, if you need a professional financial advisor, we review them and rank them. Obviously, we have to check their backgrounds and all that. On moneywise.com, you might be able to find a professional advisor that suits your needs, rather than getting a restricted financial advisor who just sells you products and is a financial salesperson in disguise. If you get a financial advisor, an independent financial advisor who is used to working with doctors and understands what it's like in terms of your risk, if you head over to moneywise.com, you might be able to find one. And then if you find one, come back and tell us your experience. But going back to investment allocation and analysis, I do love it. I thought my going. I've always been in equity for a long time, and I like people who talk about bonds and they talk about 60-40 allocation. When you're 40 years, maybe 40 should be in bonds and 60 should be in equity, and 70-30 and all of that. Obviously, it comes down to your risk allocation, risk appetite. In my own assessment, the price is volatility, the price you pay to get all those gains and all those returns that you're going to get in the future. Because if you look at S&P 500, there's ups and downs, but over the last 40-50 years, it's all been like up. Yeah, so I like that aspect of thinking. What do you say to someone who looks at, I think last year, I think we are doing like 84% the last 12 months for my own private, obviously, equity that I'm holding, and 84%, and then maybe that's driven by one, let's say Meta hitting 105% because I bought it when everything was crashing and people were selling, as is my usual approach. I don't look at a stock that is popular, like I wouldn't go biotech, but obviously people have different approaches. And then we've got, like, I still got a portfolio there. I've got something in the portfolio that is losing money, like a company like Alibaba, not professional financial advice. And then you've got things like let's say Coinbase, which I did a very good DCCF, did analysis, and I thought I couldn't miss with this one. Then it went down and I thought this is rubbish, and now it's almost doubled. And I'm quite happy to see it with risk and volatility. There are other things in the portfolio, obviously, like Berkshire Hathaway. And I don't recommend this to most doctors just because I know the amount of time and flexibility I have and the amount of I'm interested in it. I'm happy to read about it. This is not for doctors. What do you say to someone who's saying, well, I want to capture those type of returns, and but I'm a busy doctor. I don't want to do any of that. Or a busy nurse or physiotherapist. What would you say to such a person?
It's a tough one. I would just go and say go buy indexes. If you don't want to spend that time, there's no point. Just go simple. Indexes.
And if you want to sleep well,
exactly. If you want to sleep well, just go indexes. Because I can hear indeed, you want the return. Obviously, the return is very exciting. You're like, oh my God, look, they doubled in, I don't know, like in the year. Obviously, it sounds great, but you have to be able to pick the winners, and it's not that easy as a job as it sounds.
It's very hard.
And I know often on the internet you would see people say, oh, and I've done trading and I've been in and out selling and buying, and then I'm making 5,000 a month,
and they're in the garage or somewhere, and maybe they're in the garage.
It takes a lot of time to understand how it works, and really to pick the winners, and also, as you said, not necessarily going after the popular ones. Sometimes the gems are in the unpopular ones, the one that no one really look at, and it's being able to get that trend very early on. And then it's literally a bet in the future. It is a bet. This company, the way I see the future going, this company will do well. And
excellent.
This unfortunately it's time, because you need to configure your vision of the future and then pick the company you think will fit with that vision of the future.
I like the honesty about it, because a lot of times I try to explain to people, I don't recommend individual stock analysis, but if you decide to go into it, just understand, just like in your case, you wanted to be a doctor, you went to work in the toughest part, you knew how it works, now you understand the risk, you understand the downsides, but you still want ahead. And I say to people, if you lose 99% of your money, or if it on paper it seems you're losing the 99%, will you still be able to sleep? Because that could happen. I mean, you could have made a good bet, like when you bought a company because everyone was selling it, but you had an alternative theory because you're a contrarian thinker and you think you're bright. What would you do if it all went down and you still think you're right? You're going to hold out for the next 2 to 3 years. Would you still be able to hold it? Because most people don't realize the stock market is going up, it could come down, and a lot of what happens is that people sell off at that point, and then they have a permanent loss. So I'm going to agree with you wholeheartedly on that, and I'll tell you a little secret. Well, it's not a secret. My little one, so when I start investing for him, it's not individual stocks, because I don't need him to take the same risk as I did. And also it's basically indexing, capture the market returns and all that, because I'm quite happy now in terms of the risk. And I do suggest people, if you're not sure, maybe take just 10% of your portfolio and play around with it. You can use your 10%, use it to find out if you're good at it or not. Find out if you get sleepless nights when the stock market is crashing or not. Because when you hear, I've got all these platforms, they say you can practice online. It's not the same as real money. It's very different from real money. Because there's the psychology, isn't it? There's the psychology of money. And that leads me to a very interesting segue. Is the book club. What all the Moneywise Doctor community is reading from April to June is the Psychology of Money, which is a book by Morgan Housel. All right, so we're talking about Psychology of Money. Morgan Housel did a fantastic book on that, which is looks at money not from the numbers, because you know about the numbers, Vanessa. You've been in that job. You know what is alpha. You know when you're bidding the market, and you know what is better. You know about investment portfolios and how to do your risk analysis. But what the numbers don't capture is, maybe the numbers capture it, is the psychology, how we're thinking about money. From your background as an investment banker and then now as a doctor, what can you tell us in terms of psychology of money, especially regarding doctors? How what's our psychology of money and how it affects how we handle money very well or very poorly, depending on what you think. What do you think?
I think we can use, for example, we get a lot of trainings when it comes to a crash call.
Okay.
And when you go for
crash call, so just for those who don't understand, so if there is a cardiac arrest and all that, yeah. Okay.
Yes. So when you go for a crash call, the team organize itself, to deliver the best care possible for the patient who is crashing.
Yes.
But we should be in a similar state of mind when the stock market is crashing.
Oh, okay.
What is our process to deal with that?
Oh, okay.
And most of the time, or at least that's the way I see it, most of the time it tends to be temporary. So you just have to hold your guards and think, okay, how much can I afford to lose? And technically, it's not even losing; it's a virtual loss, because as long as you haven't sold, you haven't lost any money.
That's paper loss.
Yes, exactly. That's a paper loss. And so you could think, okay, how low am I okay if it goes to zero? Because it can go to zero with a crash. Am I okay with the company goes bankrupt? But if I'm not okay, well, then maybe I should sell now. But if I am okay, then I just hold my guard. I hold my guard and then wait to see where it goes, and then have a process. And it's almost like, so you have this process, but then you can have the reverse process, which is, okay, everything is going down. Which company I think is now undervalued and I can invest in?
So I think I understand that bit. That's the bit I like.
Yes, you should have both, as in, okay, it goes down. How can I manage this? Am I okay? It goes to zero? Yes, okay. But it goes down on the other side means maybe there are some golden nuggets that were probably overpriced before. Now they are at the right price or even below the right price. Let me invest in that and just wait. And then this is what I've noticed Warren Buffett has done a lot, at least in 2008 for sure.
Yes.
Where he picked up a lot of banking stocks.
Yes.
At just
cheap, Goldman Sachs, and then he does it again and again. But that's why I've been quite influenced. I don't know if I've got my book here. 1 minute, I'll grab it. So I've been quite influenced by this book. I don't know how it shows up on camera. The Intelligent Investor. It's a hard book to read most times. And having read it as a young, maybe teenager, I had to read it quite a few times to understand it. But I know he was Warren Buffett's mentor and talked about trying to find the nuggets and all that. Obviously, Warren Buffett, with Charlie Munger's influence, shift to a different style of investing called the DCCF. At the end of the day, it's all about trying to find undervalued stocks. For instance, if I told you that I really needed money, but because the housing market and economy is not great, I've got a house in London that is worth 500k, and but the market is not great. Nobody's making me an offer. I'm happy to sell it right now for 200k. And if you're a real estate investor, you're in the house for a market, you probably will snap up that deal. Because you think the house is going to be there. But for some other people, I think, but what if this house gets burnt down? Most times you're not thinking in that direction. You're thinking, but for stock market, you're thinking, what if it goes down to zero? Which some companies have gone out of business. But that leads me to index funds. An example is S&P 500, which is the top 500 companies in the US, which most times represents a large part of the global stock market. 500 companies based on capitalization, so their size. We're not looking at their returns on investment or anything. We're just indexing them based on their size. So we've got companies like Apple, Tesla, and obviously it's all the biggest companies. And people tend to say, it's just in US. But I'm thinking, hang on, Apple is in China, they're in England, they're in UK, they're everywhere. So for someone investing in the stock market and thinking, what if it goes to zero? What do you have to say if they're investing in index funds? Are you worried it might go to zero? I have an answer for this, but I want to hear your perspective.
It would be literally, unless the whole world goes to zero, it would be pretty much unlikely, because the idea is you have the 500 biggest companies in capitalization.
Yes.
So when the capitalization drops, then they drop out of the indexes, and then they would be replaced by someone else.
Okay.
So would be, as I said, unless everyone goes to zero, it would be unlikely that the whole index would go to zero.
Excellent.
So in that sense, you're covered in a way. Rather than if you go for one company, then this company alone, yes, can go to zero.
Okay. I mean, I've got a way to think about it, which I totally agree with you. But look at the picture I paint in my head, and I suggest to people to think about, because as doctors, we're trained to avoid risk. So even when index fund, people are afraid to invest in the stock market, which is a very costly mistake, isn't it? Because just saving money, inflation erodes it. Bonds is not enough because of inflation. The way I think about it is this: the top 500 companies in the S&P 500. There are Apple, there's Tesla. Which other companies can you think of, if you can remember anyone? Just off the top of your mind, there are quite a lot of them. Our day-to-day lives tend to be involved. If it goes to zero, I mean, they all collapse on the same day. If the top 500 companies all disappear, they melt, they go to zero on the same day, they're not coming back, then you've got more things to worry about. Not your investment, not your money. How about my safety? Is there been a zombie apocalypse, or is the world coming to an end? Is there even light? Is there even safety? Is there even basically energy supply for us to navigate? So my worry at that point, if it does happen, will not be about, oh, my investment returns. It's probably, are we safe here?
Yeah, my own safety.
So that's where I look at index funds. Obviously, I'm not going to go into Morgan Housel's approach, but basically what he does was to look at money from the psychological aspect, and in terms of what are you comfortable with. Yeah, you might be able to get 100% returns, but would that bother you? Are you worried if the market goes to zero? Because let's face it, the only reason we're able to capture returns like we do, or like we do in some years, is because at some point when people were selling, we were buying. And when people were buying popular stocks, like things like Tesla, everybody wants Tesla, and we are just like staying away and all that. So that's part of, because I've seen people who say, well, I bought the same things you did. How come? I have a friend in my community, Moneywise Doctor community. They bought similar things, and sometimes exact things, but they have worse returns. And then when we looked at it, we realized that they bought it when it was popular and sold it when it was no longer popular. So we're all in agreement. Index funds, all right. Yeah, that's a lot of nuggets, Vanessa. Thank you so much for sharing. I think, to be honest, for any doctor or healthcare professional watching this, I'll say go back and rewatch it again. Have a think about it, and if you have any questions, pop them in the comments. I'll do my best to answer, and if I don't know the answer, I'll go and grab an ex-investment analyst, ex-investment and banker Vanessa here to give us her answers. So what advice, or let's say what suggestions or tips would you give to a doctor or healthcare professional who's just starting out, or maybe they've even been a consultant, they've been working for a while, but they're just starting out to take charge of their financial future? They've not done anything. They've just got like a bank account. They save a bit of money, and they're not investing. They just want to start. What would you suggest as a starting point? And assume they have a child too, or two.
Assume they have a child. Well, first invest for the child.
Not for you, for the child first.
Yeah, because I'm assuming you would want the child to go to uni.
Okay,
so
maybe.
Now,
maybe.
And that's what I'm assuming.
You've got 2 degrees, so
yeah.
Maybe.
Probably doctors want their children to go to uni.
Okay.
And so if you start now, by the time they are 18, they could have a very interesting pot of money. And you don't even have to spend that much. You just probably like 100 every month, and it would get like a really nice pot after 18 years. But then on as a doctor, definitely. And even me, I'm still on the fence as where to start. Would you start with stock market, or would you start with real estate?
Okay.
The advantage of real estate is that you have something tangible.
I do both.
Which is, but then which one did you start with? Real estate or stock market?
I started with stock market when I was a teenager, but when it came to my little one, I started with property because I had one then. I just said, okay, this is for you. I could have done a junior ISA, which is fantastic, £9,000 tax free. But I thought, well, I don't really know what you're going to do at 18. I mean, I trust and I believe in the future, but I don't know. There are a lot of 18 years old that wouldn't hand over the keys to the kingdom yet. And I look back at when I was 18, I was really an intelligent investor. But again, we all follow different pathways. So some people wouldn't want to start a junior ISA because they don't know if their 18-year-olds will blow it up in one big 18-year-old party and crash a Ferrari or something. So real estate has some flexibility. Obviously, over the long term, the stock market clearly does better returns than real estate, but real estate has a bit more control, a bit more tangible. So I tend to like a bit of both, and if someone wants to, they can dabble in a bit of both. But if not, if you're just looking for one vehicle, obviously buying an index fund for them that you then put in something automatically. You talked about saving, and we tend to suggest a system called AMAS, so automatic monthly activated saving systems. Is a Moneywise Doctor who string words together and make it a system. What it just means is that you set up a direct debit, it takes off 100, 200 every month. You don't think about it. It goes into a pot, you invest it automatically every month. It's going into a broad index fund. That way you don't have to think about it, and there's peace of mind knowing that, oh yeah, it's working there. So that could be an option for someone who has a baby and they're thinking, oh, I want them to have something. Again, not financial advice. If you want specific financial advice, you know where to go, moneywise.com, or find one online. Right. I think that's an interesting angle you brought to it, Vanessa. Real estate or real estate, that's property or stocks. Because again, investment is psychological. We're not looking at the numbers. We're not looking at which one does better. We're looking at which one are we comfortable with that'll give us returns, and we also feel in control. Is that why you're thinking about real estate? Is that why you?
Yes. I think generally speaking, people are a bit more comfortable with something more tangible than the stock market, because you can see the house for yourself. You can see the people you're going to rent it to. You can judge, assess, you can see how it's growing, the value of the property. So I think in that sense it can give like comfort in for your mind,
peace of mind,
where our money is going, which is maybe a bit more blurry when it comes to the stock market. That's why I'm thinking if you have to start and you're a bit hesitant around the stock market and you're like, oh, it goes up and down, then maybe real estate, then it's probably a better first investment than the stock market.
So we're back to the psychology of money again. And part of what we've got on Moneywise Doctor that comes a lot of mortgage. People want mortgage, they read our articles and they want a mortgage advisor, and they end up sometimes with their bank mortgage advisor who can only sell them products on the bank's books. If you want a salad and you're coming to a pasty shop, you're going to get a pasty. Or they end up with restricted mortgage advisors who work with a big group, but they've only got this panel of 20 advisors. So we tend to suggest going to an independent mortgage advisor, which is basically, some of them are on the website there. You can reach out to them, but part of what they do is to look at the whole market. And because right now, today, I'm going to sign a mortgage paper in the middle of remortgaging. I've done one last month, so I'm at that point where I realize, they're finding a bank that I've never heard about. And if I went to my regular bank, high street bank, they probably, and I got like far better offer than what my high street bank was offering me. And I realized, just getting an independent advisor who can look at the whole market rather than selling me just what they have, it tends to make quite a difference. Do you think that matters when it comes to real estate or even just investing or getting an advice? Does it matter what advisor you pick? How do you look at things like their incentives and all that? Or is it all just the same?
No, I think especially when it comes to looking for a mortgage, and because the interest rate is critical.
Investment banker talking.
Yeah, I mean, that's you have to look at the interest rates, especially if you do a mortgage. You have to look at how long you're going to fix this, or do you want to fix it, or you don't want to fix it. But then so if you can get the best interest rates possible, then I think it's worth going after an independent advisor, because
Wow.
I'm pretty sure I would say most of your audience, if they bought their house about 10 years ago, had a really, really low interest rate.
Yes.
Probably fixed it for 2-5 years.
Even 5 years ago, even 3 years ago, I had interest 0.1%.
Exactly. And now
it's 5.
It's like 5%, 5 or 6%, the interest rate.
Yeah. It's
probably
all,
their
it keeps changing.
Yeah, it keeps changing. It seems like we're probably going to go a little bit more up in terms of the interest rate to continue to fight the inflation.
Yeah.
So then your mortgage payment, monthly payment, has probably not doubled, but not far from doubling. And then you end up, how am I going to pay for this? And your salary hasn't doubled.
Salary hasn't doubled. Income hasn't doubled. In some cases, people have had a lower income now. Maybe they were looking in and then they're getting lower income now because the rates have dropped and all that. So I agree. It's important. Interest rate, sometimes shaving off 0.1% or 0.01%, 1 basis point in your interest rate, could be enough to pay your weekly or monthly income. So it's really quite important. Wow. Yeah. Vanessa Awong Eya'a, doctor, NHS doctor, entrepreneur, ex-investment analyst. I don't know if you knew from the listeners, I've had to move my next meeting because I was finding it as a very interesting conversation. I hope you enjoy it too. If you're enjoying it, tell us in the comments or hit the subscribe button if you like to get more stuff like this, or give it a like or thumbs up or thumbs down. It doesn't matter. Let's just know what you feel about it. And if you think you've got a doctor or healthcare professional who might like it, go ahead and share it. But now I want to zoom in now before we wrap up on what Vanessa is doing. You've had a very interesting, varied career. You grew up in France, didn't you? You were born in France, and you went to your first training, your business training, there in France. You worked in investment banking when your colleagues were going off to work in L'Oreal or and all that. Yeah, I know you mentioned your colleagues are going to work in L'Oreal, which is fashionable. I mean, I don't think they'll take me, but but you decided to go into the numbers, investment banking, BNP Paribas and all that, and then you became a doctor after testing it. So you are not under any illusions about the difficulties of working as a doctor, and now you're an NHS doctor, you're a mom, and you're currently working on a fantastic new project. I want to hear about it. Tell me.
So yeah, it seems like every time I go on maternity leave, I'm starting having business ideas, probably because I have so much time on my hand.
Oh my. Some people go on maternity leave and they're thinking, I'm so busy, I'm not getting any sleep. But Vanessa starts a new business. Amazing.
So literally, it's literally that. So, as I said, I've tried a bunch of stuff. I tried drop shipping, for example, at some point. I think I've tried it all, but it never really fulfilled me. I think I was doing it more for the money, but then I thought, no, but I can't withstand the whole pressure. It's like proper jobs.
I know what that is like. I've got a drop shipping site. I've had that for 4 years or 5 years. It's profitable, but I don't wake up in the morning and say, I can't wait to take an order. I mean, it's good money, but imagine I'm working on Moneywise Doctor.com without a salary, and I'm pumped. Let's go do it.
Exactly.
Maybe to pay at some point, but we don't know. We'll find out.
It does make a huge difference. Anyway, so decided to go into an accelerator to find a co-founder, because I thought for this one I don't want to do it alone. I would like to have someone else to work with me, and someone who also sharing the idea, the mission, and the passion. So went into an accelerator, and then I found a co-founder. Her name is Emily, and we to dive into women's health.
Excellent. Can I just pause you before you go any further? Some of my audience don't know what an accelerator is. I'm interested as well. Tell me what's an accelerator. I've got a couple of friends now in accelerators in Silicon Valley, and then you here. So what's an accelerator?
So the accelerator is usually a 10 to 12 week program where we take people, depending on the stage of their ideas, and we give them, or they give us coaching advice on how to accelerate the progress of the business. So it's most of the time is for tech companies. And then the idea is, if they like what they see, the progress, the team, then they can invest. Some accelerators invest at the beginning, some accelerators invest at the end. So YC, so Y Combinator, so probably the most famous accelerator in the world.
Paul Graham's Y Combinator, where Uber came from.
Exactly. So they invest at the beginning. So once you start the program, you get an investment, and then they help you accelerate your business, because it's all about growth and growing quickly. The one I went to, they don't invest at the beginning, but if they like the idea, they invest at the end.
All right.
So for us, basically, we were too risky, because that's the thing with healthcare.
Ooh, I want to invest. Too risky.
It's because we have to go through regulation. That's just part of the business. And a lot of investors, so VCs, so venture capitalists, so they are the investors who tend to invest in tech companies. They don't, if they can avoid it as much as possible, they will avoid regulatory or regulated risk industry. Except for fintech.
Why?
So fintech is so when you want to do financial, when you want to improve the financial world using tech, so they call it fintech. Because it is regulated.
We've got the money box and different apps and all those.
Like the Starlings, the Monzo.
Monzo. They're all fintech.
Neobanks. They're all fintech. And it is regulated, but the loophole is that they can use already regulated companies as almost like umbrella.
Oh, I see.
To start selling some of their products. So that umbrella company will take on, so already has all the regulation in place, the compliance. So you can use them to go into the market, which is not the case for healthcare.
But in your case, healthcare, there's a lot of regulations, and rightfully so. But what I tend to think about in companies I do invest, whether it's startups or established companies, is a moat, like something that prevents other people from entering. So it's hard. You're doing a very hard field, but if you do manage to get it, then it's like a moat. It prevents. If you think about a castle, Warren Buffett has this analogy. You've got like a moat surrounding the castle. Maybe there's a water. You can't get into the castle. There's a lot of crocodiles and things inside it. So if someone thinks, I want to go into and do what Eve is doing, I want to do what the company is doing, they've got all that to think about compared to starting a podcast or doing another fintech company or throwing up a website. So you've got a huge moat that if you do manage to get it, and I'm rooting for you and your co-founder, your team. I think we've had another tech founder on the podcast who also had a run at the company. Didn't succeed, but lots of learnings, and they open up a new way. So if you do manage to get it done, that regulatory framework that you're trying to jump over now, or that's preventing you from getting investments, could actually be your defense. But hopefully, I'm thinking we should hopefully get more investors. So if you're listening to this podcast, because we've got a few investors who are doctors also. I don't mean just sort of buying stocks. Some of them listen to this podcast. So if you're interested, reach out to Vanessa and her team, find out what they're doing. I think one of my colleagues as well will put you in touch. It was going to be some sort of advisory capacity as a specialist. But where can people find you if they want to support what you're doing, or they want to understand what you're doing, and even investors or advisors or whatever, teammates, how do they find you?
So mostly LinkedIn, and indeed we are on a fundraising tour for Eve.
Okay.
And to explain what we want to do, we want to use menstrual blood to analyze menstrual blood and do like a home testing kit. Ooh. So then you can diagnose or you can monitor some medical conditions.
Really? Hang on. Do you want to explain that a bit more? So you want to take menstrual blood
Yes.
To analyze medical conditions.
So to monitor. So the same way you would use like venous blood.
Mm-hmm.
And instead of using venous blood, then you would use menstrual blood. And the thing is, like, it's non-invasive, it's super convenient, and you can do it from the comfort of your own home. So for example, we're looking at, let's say, diabetes. If you want to monitor diabetes, you could do the HbA1c not on the venous blood, but on the menstrual blood instead.
Wow, that's a big one. That's a game changer. So you don't have to wait maybe 3 months or 6 months, come to the doctors and have your hand and have a needle stuck into it. And this could be a big game changer for my patients who are needle phobic. Usually tends to be a big, huge ex-army guy, and you think, it's not going to pass out, and then he passes out on you taking blood. Yeah, but they might not have, depending. So menstrual blood, so that's quite interesting, because femtech is an area where I think there's a lot of interest going on now, and obviously raising funding and all that. If you have the right investor, the right banking, it can be quite groundbreaking. Yeah, so you do like a challenge, don't you? You like challenging stuff.
I think I do. That's
yeah. You're not starting a coaching business or help you to you're going into.
I like the idea of creating something, and really the more I do the research around menstrual blood, because it's been completely ignored, and only recently you have seen some papers research around, actually maybe we can do something about this fluid that comes out every month. For free, it just comes out, we might as well try to use it. And the potential of it is it's crazy, literally crazy. And indeed I think it would help particularly GPs. Instead of having to book a phlebotomist, and as you said, if they are needle phobic, it could be like instant. We could send the results to the GP, and then they could look at it, initiate treatment, maybe with just online consultations.
Wow.
So the idea is great.
That is brilliant. That's amazing.
Even greater.
I think that's amazing that you're looking to tackle that. And obviously, I don't know who might be your future collaborators, but when I start a business, I like to think about who's going to buy it. I'm already starting to think about companies that sell tampons like Always and the rest of that. Maybe might be investors. I think there's a few other like Flow or other companies in this tech space as well. So that is an amazing project, and I was going to ask you how you got into that area and who's your co-founder. But maybe you might tell us in one line, why did you decide out of everything to say this is what I'm going to do, and tell us a bit about your co-founder and how you picked.
So she's the commercial queen in the team. So I'm the medical and the finance, and she's the commercial one.
Hang on. So who's building the product?
So the building the product, we're partnering with the lab.
All right. So you've got a medical expertise, which you've got an unfair advantage being a doctor, having a network of doctors. You understand how money works. You've worked in investment banking, and she's a commercial sort of like go-to-market person, help to promote it. Is that the case?
Yeah, that's the case.
Okay.
Yes. So very complementary skills, and literally it's because one day we were brainstorming. Ideas around women's health, and I did say to her, I have not heavy periods, but difficult periods where I get headaches, I get pain, and it's a shame that there isn't something to try to alleviate the period pains. And then she asked me, but why don't you analyze the period bloods? To which I think I laughed, almost laughed, thinking, why would you do that?
Oh wow.
And then I started thinking, wait, actually, why don't we do that? It's true. Why don't we? It's there. We might as well use it. And then that's how we started thinking about the idea and how can we make it viable and the research around it. And then we decided to go for it because the research is already there. Now it's more a matter of building it. And also doing the feasibility studies, because the research is more like US, China. We haven't seen much here in the UK. So we have to do the feasibility study. And then we have to do the study anyway for the MHRA, so the Medicine Healthcare Regulatory Agencies for all the medical device.
Yeah.
They will require a feasibility study, a safety study anyway. So
you've got your work cut out for you. I'm rooting for you. I think basically what a startup is, you're taking a risk and you're building something that, if it works out, is going to change people's lives, and is also going to pay off quite handsomely, not just for you as a founder, but for the investors as well. So yes. I'm sure when you get to the next stage, so I'm inviting you, you can come back and tell us what you're doing. So you're welcome to come back. I've got my friend who's had me on his podcast a while ago on his YouTube channel. He's got into Techstars 24. So Techstars is an accelerator. It's in Silicon Valley, and they are building out a product for Locum doctors. And he's had this is his second time of running a business. Well, the first one was bootstrapped, and I'm aware that he's gotten funding from the Techstars. Yeah, so I probably will get him on this podcast to bring him to get his own ideas and all that. Who knows? Might get all you tech founders together to have a chat.
Yes, especially with pleasure. Doctors. Yeah, we can share stories, difficult stories, winning stories.
Yeah. Well, I commend you for tackling that difficult problem, and I'm sure that I'll be able to win some way, because I look at it as it's either the product works out, or you learn a huge lesson that you can use for the next one. Yeah. Final thoughts. Well, maybe you will tell me your own final thoughts, but my own final question is: any regrets? Do you regret going from investment banking and all that hundreds of thousands of dollars you were getting, and the dinners and wearing the best suits and gowns, to swapping it around to scrubs and running around bloods and pee and poo and getting shouted at sometimes by patients? And do you have any regrets from going from investment? No, not at all. Tiny?
None.
Any bit?
No, not even one bit at all.
No regrets.
No regrets. No, and although I have a bit of almost like a weird career, now I think I'm just starting to appreciate the training in the financial world and in the training in the medical world.
All right.
And as you said, I feel like now I'm bringing the two together. In a company that makes sense on both sides. So I can speak the VC language. I understand what they mean.
Yes.
And I can speak the medical language as well, because I do understand what they mean.
That's a big unfair advantage. Yeah. Did I just say weapon? Actually, I was thinking it. Now I said it.
You did.
It's a big unfair advantage being able to speak, just like me being a doctor, being able to talk to financial advisors, mortgage advisors, and I understand the numbers. It's obviously from yourself, having worked as an investment banker, and then you're saying, no, we're not woo. We're going to change the world. We're going to change the world and make you some money. Then the VC pulls out his checkbook and says, tell me more. Obviously, there's more due diligence than that. I'm sure even if you don't get a VC at first, if you get some angel investing and all that, which is more like the level where we play at, or maybe a little below that level, angel investing. So if you get some seed fund going, at least you have some money to pay the lab you work with and all that, because I'm sure that could be your main expense. Right.
Yes.
Have you got any parting words or anything you like to say before we end what has been an amazing look? We've gone 78 minutes.
I know.
And I feel like we're just starting. Look, if you're listening and you have a question for Vanessa you like her to ask her, if you're not sure, maybe you're thinking of starting your own company. You've had Claire Ashley come to tell us how they started their own company. You had Vanessa. You've listened to other doctors, or maybe you're interested in investing or pension. You've got a question to ask, or you're worried. You're thinking, should I leave my job or should I not? Pop it in the comments, and we'll do our best to answer them. And if it's required, we'll bring back Vanessa to answer them herself. So, final thoughts.
No, thank you very much. You can find me on LinkedIn. I'm sure, Andy, you would put my full name, because my last name is a bit complicated. So I'm using LinkedIn a lot. So if you have any questions, I'm happy to answer.
Yes.
And then one thing I was thinking about, and probably it would be for another podcast, is So the impact of AI.
Oh, okay.
In my allocation, so I'm back to the investment part. In my allocation, I have part of my allocation into emerging countries.
All right.
And then I thought, well, emerging countries is great because they have cheaper workers, and that's why companies go to them.
Okay.
But now with AI, you can literally do most of their jobs with just a computer. Are they gonna still need those cheaper workers?
That cheaper labor.
Exactly, the cheaper labor. So should I change my allocation to actually decrease the emerging markets because they might not get as many opportunities because of AI, and literally bet more on developed countries? I would just go, like, the gap between them would just go like wider. It's literally just a thought.
That's an interesting thought, and I think I agree with you that it might form the foundation of a very detailed conversation, because I like AI and I like practical use of AI, but I'm looking at it from the other aspect. If you think about me, I've come from Africa, I've come from Nigeria, and I've moved to the UK, and even while as a student, or before I became a medical student in Africa, in medical student in Nigeria, I was able to access Warren Buffett and all that while still living in Nigeria because of the internet. So I think that technology might sometimes give emerging countries a bit of advantage, to give them the ability to leapfrog if they make advantage of it. So while it might not need cheap labor and all that, but you might end up being able to sort of catch up, leapfrog, and it's a romantic view of it. But then there are possibilities as well, because if you look at it, AI is not just getting rid of low level skills. Now you're getting things like accountants, lawyers. I've had people use AI to draft legal agreements. Not people, me. Draft legal agreements and then get a lawyer to look at it. Then it's cheaper for me because I haven't got to pay that many hours. They've had other things, analysis, and and all that. So let's see. Let's watch this space. I tend to think that rather than run away from it, embrace the trend and see. A lot of people in medicine might be a bit scared of AI and all that tech, but I'm not one of the LinkedIn health tech experts, but I'm watching the space basically as a human being, as a doctor, as an investor. I'm watching to see what this might be in our generation.
I don't think it's going to come that soon for healthcare.
You don't think so? Why? No. Regulation?
Because of the regulation, yeah, exactly. And because of the responsibility, as in, if the AI does the job and there is a mistake, who's going to be blamed?
Oh, okay. So doctors, nurses, pharmacists, healthcare professionals listening at home, you're safe now. Your job is not about to be taken away by ChatGPT and AI. So if you're listening at home, thanks to Dr. Vanessa Awong Eya'a, you can rest easy, but keep an eye on the technology. Wow, Dr. Vanessa Awong Eya'a, has been amazing having you in this podcast. Now, if you're listening and you're thinking about how to get hold of her, I'm going to put the link to her LinkedIn. Oh, I like the sound of that. Link to LinkedIn. I'm going to put that in the description notes. Go and check her out. She's got some amazing insights, and this is just the tip of the iceberg. Follow her journey and the exciting company they are building in Femtech. And of course, if you're a doctor or healthcare professional, you like to continue to get content like this, subscribe. If you click the subscribe button, I'm going to deliver it for you at a very little cost, £100 every month. Oh, it's actually free of charge. So click the subscribe button, and you can also sign up for our newsletter in the link there, so in the description, so you can get our newsletter delivered to you every week with insights on investing, taxes, and how to start side hustles and make the best financial decisions. So thank you so much for joining us, Dr. Vanessa Awong Eya'a, and hopefully we'll have you back again when you're on the next step of your journey. All right?
Yes, it's a pleasure. Thank you,
Cheers.
Andy.
Bye-bye. Bye.